Winnie, we've talked a lot about fixed income, yields higher on a 10-year, 30-year. Let's talk about the other side of fixed income, credit. Walk us through why credit spreads are so tight still and near the tights of 2023.
Hey, good morning, Jonathan and Lisa. Thanks for having me. So credit spreads are definitely still at the tight end of the range, which is quite shocking. When you look back at when the 10-year was at 424 last October, investment grade spreads were making their wides for last year around 170 basis points, whereas they're now around 120 basis points. I think there are a few factors. First is the material shift in expectations for fundamentals, getting a little bit more positive, seeing the path for a potential soft or no landing is generally a positive thing for credit spreads. I think second, it comes down to positioning for much of the year. At the beginning of the year, people were still pretty bared up on the outlook for the economy. And with that, people were not necessarily putting a lot of cash to work in corporate credit. And it feels like a lot of investors have been chasing the trade as spreads have tightened over the course of the year. And then the last one is just technicals. We have not had enough new issue supply to really put a dent in the demand that there has been for fixed income. When you look at corporate credit relative to equities, it still looks very attractively valued. And so we do think that there is that marginal demand that's going to continue to support credit spreads, although we don't think that we're going to get much tighter from here.
Winnie, John asked me a question earlier this morning. He said, how do we know that rates are restrictive? And I kind of hemmed and hawed and tried to come up with something to say in the moment. It's a great question, though, at a time where risk assets are saying this economy can look through benchmark borrowing costs of 4.3%. At what point do yields rise to a level where it's clear that they will have an impact on the ability for some of these companies to refinance, on some of the economic momentum that everyone keeps relying on?
Yeah, it's an absolutely great question. And I think there's a lot of confusion around restrictive policy and what it really means. When we look across the broad spectrum of corporate credit, we are seeing that rates are restrictive, or policy is restrictive for those lower rated, highly leveraged borrowers that don't have sustainable capital structures. Defaults are rising, not at a super rapid clip, but definitely at a pace that indicates that there has been tightening in the economy. We've also seen a shift in terms of how management teams are talking about their balance sheets, a move to a much more prudent and disciplined capital structure endeavor so that we're not seeing a lot of pressure on the rating side of things, trying to avoid a downgrade from investment grade to high yield, trying to maintain ratings and really maintain access to capital through a bunch of different avenues. We're seeing not just management teams issue corporate bonds, but also pursue kind of unique structures through securitizations and other transactions.
What I'm hearing from you is that a lot of corporations have immunized themselves against rates and against rates going higher. We've heard that with the consumer with respect to mortgages that are locked in for 30 years. We hear that with corporations that are readjusting their balance sheets and reducing their need to borrow. We're hearing that from a whole host of places. Is the implication here that right now, longer-term rates at 4.3% are not sufficiently restrictive to really materially put a dent in any business model that we can see right now out there?
Well, I think that it is putting a dent in some business models. There are definitely business models, particularly in the leverage loan space and likely in the private credit space, where they are running into liquidity challenges, where they are running into challenges around capital structure sustainability. It's just not the big kind of U.S. investment grade corporate issuers that are running into trouble at this point. Eventually, higher yields will become an issue, but so long as earnings are kind of good enough for credit and earnings are growing at kind of an inflation-adjusted pace, then much of the corporate credit universe should be in fundamentally pretty sound shape. And the Fed's restrictive policy is not necessarily intended to cut off access to the investment-grade world. They want to see investment-grade companies able to borrow. They still want to see high-yield companies able to borrow. They just don't want to see kind of risk-taking or highly risky behavior within the corporate credit market.
Winnie, within the loan market that you just mentioned, how pronounced is the default cycle that you're seeing emerge?
So the loan market on a default basis is actually not particularly pronounced. And that has to do with some of the kind of structural considerations in the loan market where you have the ability to amend and pretend. So capital structures can just be amended and kind of push out those maturities. And we don't necessarily have to see a true default event. Now, what we are seeing is on a fundamental side, very low interest coverage ratios, especially for CCC rated loans, which are now a higher percentage of that market. And so while we're not seeing the defaults necessarily pile up, we are seeing a lot of sponsors kick money back into their portfolio companies to make sure that they can make it through this, what is perceived as a relatively short-term spike in borrowing costs, especially for those floating rate aligned capital structures.